Thank you very much, and I'll endeavour to answer those questions. I know it's towards the end of a very long day, and I'd just like to thank my good friend, Professor Luis Schmeresh, for the invitation to speak again at this conference. It's always a great pleasure to be here, in Lisbon. I'm going to give you the view from outside of the EU. We've heard a lot during the course of today about perspectives within the EU. I'm going to give you a perspective from outside the EU. That doesn't mean that I'm going to talk about the UK, because at the moment, at least, it's still within. One thing I'd just like to mention that sort of puts the whole Brexit debate into a rather interesting context is that a few months ago I was at a conference in mainland China where the opening address was given by a vice governor of one of the provinces. And he talked about the economic progress that his province was making and that it was the home of major internet companies like Alibaba. But he said, well, but we're just a medium-sized province. We're not that large. We only have a population of 55 million people. It rather puts the whole Brexit debate into some sort of context. I'm going to talk about a political entity which is the size of a continent, which has a very small central bureaucracy that often struggles to impose its policies on an often reluctant series of lower-level political entities, which has a bank-dominated financial system, and the banks may be sitting on significant unrecognized losses. I'm talking, of course, not about the EU, but of China. I've got three key messages. Marco this morning had a 6-act opera. I have a 3-act opera. It's going to be, I promise you, quite short. And as in all the best operas, in the final act, everyone ends up dead. This is based on a piece of research that we published quite recently, which was in response to a question that I was receiving frequently from investors. And that was, is China at risk of a financial crisis? Is there going to be a risk that China is going to have a financial crisis, what's sometimes referred to as a hard landing, the expectation that there could be some kind of serious systemic problem in China? And the answer to that is no, China is not at immediate risk of a financial crisis, for reasons that I'll explain. But there will be a moment where these potential vulnerabilities start to become more apparent, and that's the second point, that rapid financial liberalization would reduce the authorities' ability to manage systemic risks. And then the final observation is that although an immediate-term financial crisis might be avoided, the consequence of that is going to be what we describe as a slow burn scenario in which there's a gradual deterioration in terms of credit quality, in terms of the rate of economic growth. And under some scenarios, you could say that this is an outcome which looks very much like the outcome in Japan, although it's not necessarily given that that's the way that China's going to end up. I'll skip through a few of these slides in the interest of time. Why are investors so concerned about the possibility of a financial crisis in China? Well, simply because there has been a very rapid build-up of debt. As you can see on the left-hand side chart here, this is non-financial sector debt. And as you can see, there's a break in the series around about 2008, 2009. For most of the 2000s, China's debt to GDP ratio was relatively stable. You didn't see a very substantial run-up in debt. But then in 2008, 2009, with the global financial crisis, the central government decides to implement a stimulus policy to prevent the economy from slowing down more sharply. And the way that that is implemented is through infrastructure spending, which is financed essentially by bank debt. And the entities that engage in that investment and infrastructure spending are largely state-owned enterprises. So what we see is that that the debt of the household sector, general government debt, don't rise very much, but the corporate sector debt really rises quite sharply. And as you can see on the right-hand side here, the increase in China really outstrips any other country over this period, period since the global financial crisis. So we've seen a very rapid build-up in debt. And that gets investors concerned, because if you look at the IMF data, what that suggests is that countries which experience a debt bubble of this size and scale, this kind of very rapid run-up in debt, they have almost without exception gone on to experience a financial crisis. And in the 3 years following the financial crisis, they have experienced very sharp drops in output, in economic output. And as you can see on the left-hand side of this chart here, we've got, no, that's not it. We've got countries like Greece, Thailand, Ireland, Uruguay. Uruguay gets in twice. They had two crises, one in the late 1990s and one earlier than that. Malaysia. All of these countries have experienced financial crises and after this period of very rapid build-up of debt, and have gone on then to experience a rapid contraction or a substantial contraction in terms of output. So that's the worry. When you see the kind of rate of debt build-up that we've seen in China, it seems to point to this kind of financial crisis. However, there are some mitigating factors in China's case. The first one is that a lot of the debt that has been built up has been internally financed. This is domestic savings that have been used to finance this substantial investment and infrastructure spending. That means that China is less at risk than many emerging economies have been of what's sometimes called in the economics literature a sudden stop. That's to say, they lose access to lending from international capital markets or international banks. They're unable to refinance this foreign debt, and as a consequence of that, they suffer a financial crisis. China's debt is nearly all domestic, and for that reason, the risk of this sudden stop is substantially reduced. At the same time, most of this debt build-up has been from state-owned banks lending to state-owned enterprises. The state is on both sides of the transaction, and that gives it substantial scope to exercise moral suasion to ensure that when debt is falling due, that the banks are willing to roll over that debt to refinance it, and to ensure that debtors are able to obtain refinancing. Similarly, it also means that the state's involvement in the financial system means that it's very unlikely that China will experience what's sometimes referred to as a Minsky moment. Now, if you read different literature in the economics literature, there's no real definition of what is a Minsky moment. It's used quite vaguely by a lot of economics commentators. But essentially the way I think about it is this is a kind of collective action problem. It's where individual providers of credit decide that it's individually rational for them not to renew the credit that they've provided. They withdraw the credit. And because each individual actor faces similar incentives, the result is that collectively the supply of credit suddenly, very sharply contracts. That's a Minsky moment. Again, if you have the state on both sides of the balance sheet, as in the case of China, then it's quite unlikely that you would experience one of these Minsky moments in the same way that it was experienced, for example, in the US in 2007 and 2008 with the rapid contraction of the shadow banking sector. So there's an important mitigating factor there. And then finally, the government in China still has quite a lot of scope to mitigate the effects of a systemic crisis. There's been substantial policy support already in the form of cuts in interest rates, required reserves, which are an important monetary policy tool for the People's Bank of China. Required reserves still stand at 18% of bank liabilities, or bank deposits, so that the required reserves could be released into the system to provide additional liquidity if it's needed. The central government has relatively low debt, so there is, again, scope for the central government to engage in fiscal stimulus to offset the effects of any kind of asset price correction. And we've seen in the last 12 months quite a lot of support provided to the real estate market, which is one of the main drivers of China's economy. So, the banking system itself has reasonably robust first line of defense in terms of still fairly adequate capital and liquidity. So, I think the bottom line assessment in this first act of the opera is that China is not at an immediate risk of financial crisis, because even though there are some very significant systemic vulnerabilities in China's financial system, the authorities do have the tools there and the willingness to use those tools to prevent a major disruption from developing. So really the question then becomes, well, what are the potential risk factors? How might that analysis change? And I think the key factor here is if there were to be rapid financial liberalization and the opening of China's capital account, which, remember, is still very much closed, at least as far as banking and portfolio transactions are concerned. Now, China's current official reserves stand at 3.2 trillion US dollars. That is more than adequate based on the IMF's rule of thumb for estimating the necessary level of reserves. Depending on whether a country has a fixed currency or a floating currency, depending on whether they have an open capital account or a closed capital account, then the number comes out at somewhere between about 2.6 trillion US dollars on the high side and around 900 billion US dollars on the low side. So 3.2 trillion still gives China a substantial buffer. However, I think the really interesting issue here is what drives the need for official reserves. And it's this column here, broad money. Short-term debt, which is often the issue that is most concerned from the point of view of emerging economies. Short-term debt in China, external short-term debt, is very low. This is not a country which has a problem in terms of having borrowed in foreign currency overseas in the way that many of the Asian financial crisis countries did in 1997-98. The issue for China is that official reserves cover a relatively small proportion of the deposits in the banking system, broad money or M2. And we've tried to illustrate this with this chart. In the y-axis, what we've got in this chart on the y-axis is what we call the external vulnerability indicator. So that's our assessment of the extent to which a country has high levels of short-term external debt. But as you can see on this axis, China really is way down in terms of potential risk. But what really is interesting here is the x-axis. Normally, or on average, emerging economies have deposits in the banking system which are around about 3 to 4 times official reserves, as you can see here, basically in this column here. Most emerging economies tend to cluster around 3 to 4 times official reserves in terms of deposits in the banking system. China is way off the scale here, 6.5 times. And that was the number at the end of last year. The trends have simply got worse since. But let's assume that it's still 6.5 times. What does that mean? It means that you only need 15% of renminbi deposits in China's banks to be converted into foreign currency and the official reserves are completely used up. So this is, in our view, a major systemic vulnerability for China. We think that the Chinese authorities understand that they have a major systemic vulnerability, and for that reason, they're going to proceed very cautiously in terms of opening the capital account. So when there's all this talk, and we hear a lot of it, about the renminbi becoming a freely convertible currency, of China opening up its capital account to allow both inflows and outflows, I think once you look at this chart, you realize why it's going to be extremely difficult to do this in the short to medium term. So the tools, the policy tools are there. The risk is rapid financial liberalization that leads to opening of the capital account, which then exposes this potential vulnerability there. And if confidence in the renminbi was to be lost, then clearly that would be a major problem for China. And certainly towards the end of last year, when we saw some very substantial capital outflows, then it was clear that China was experiencing some loss of confidence in the renminbi, which has now stabilized again, but it could easily happen again. So really the question is, how does this opera end? How does the third act play out? Well, the third act is that what we see is basically declining efficiency in the way that capital and credit are being used. On the left-hand side, we've got two factors that we look at in terms of, first of all, the incremental capital output ratio. So basically, how much capital do you need to produce a certain quantum of output? And as you can see, in China's case, there is again a very, very clear indication, starting again round about 2008-9, of the efficiency with which capital is being employed is on a rapidly declining trend. And the same is true of the other indicator that we have on this chart, which is the debt service ratio. And again, debt service in China is on a very worrying trend. So basically, capital is being used less efficiently. The cost of servicing the debt that has been built up is continuing to grow. And the return on assets for industrial corporations, and these and we've split out the private sector and the state-owned enterprise sector. The return on assets for industrial corporations, again, has been on a very clear declining trend since around 2008-9. The SOE sector in particular, which was not particularly profitable to begin with, has become even more unprofitable in the intervening years. So what does this all translate to? Well, it translates to a high and rising debt burden, which, as we've seen in the past, could result in a financial crisis. We don't think it's going to result in a financial crisis in China's case, but what we expect it to do over the long term, as the inefficiency with which capital is employed continues to decline, we expect to see growth levels continuing to decline, so not a sharp deceleration, but certainly a steady deceleration in terms of China's rate of growth. The central government and regional local governments will probably engage in additional deficit spending to try to prop up the growth rate, which means that, again, in the medium term, the credit profiles start to look worse. If the state-owned enterprise sector is not restructured, and there's been a certain amount of backtracking from reform of the state-owned enterprise sector, despite the central government having a commitment to reform state-owned enterprises, to allow market forces to play a decisive role. If there are delays to that reform, which currently there look to be, then there's simply going to be further resource misallocation. And that means that the debt levels and potential contingent liabilities for the government are then going to continue to rise. For the banking sector, again, the challenges are going to be large unrecognized losses in the banking sector, a steady decline in terms of the sector's profitability, and maybe as these trends continue, there will be pressure on the banks to continue to extend loans to entities where they doubt that they have sufficient repayment capacity, which simply results in higher levels of non-performing loans down the road. Now, China has avoided a sharp deceleration. It's avoided a hard landing. There were signs at the end of last year that the economy was slowing down quite significantly. Then we saw a round of fresh stimulus from the central government. Investment picked up again. The state-owned enterprises started to invest again. The result of that has been that growth has been pushed back close to the government's official target of 6.5%. So we very much doubt that there's going to be a hard landing in China, but the result is going to be a steady deterioration in terms of growth potential. Each category of the economy, whether we're talking about central government, regional governments, state-owned enterprises, banks, are going to see a steady deterioration in terms of the financial profiles, and as a result of that, this steady decline. And as I've said, one possible interpretation of this is that China then begins to look like Japan, or at least the Japan of 25 years ago after the bursting of Japan's credit bubble. And as we've seen in the last 25 years, Japan's been through this very long period of zero or negative growth, of deflation, of zombie companies not being restructured, of banks not writing off losses. And it's possible that this outcome could happen in China too. On the other hand, if the authorities get serious again about reform, if we start to see serious attempts to address the problems in the state-owned enterprise sector, where many of these problems are concentrated, China still has a lot of growth potential. It's experienced this credit bubble at a much earlier point in its economic development than Japan did, so it's not necessarily the case that China could end up looking like Japan, but really it all depends on the ability and willingness of the authorities to implement reform of the state-owned enterprise sector. Thank you for your attention.